Just recently, I think about last week, Apostle Joshua Selman released a video where he talked about how turbulent 2024 is going to be and how we should consider investing financially. And he mentioned about five things to invest in, of course, but then the financial aspect caught my attention. So welcome today. Welcome to my channel. Today we will be diving into a very crucial topic: what to look out before investing, before diving into the world of investing. Whether you're a beginner or you're looking to refine your strategy, this key insight would be your compass. I'll be listing um, some helpful tips and some helpful factors you should consider before you go into the world of what investing. So I want you to stay tuned and I want you to listen and I want you to get your pen and your paper. It is very crucial for this class. If you want to be an investor, and let me tell you something, investing is a wonderful thing to do. So let's get started. The first factor you might want to consider if you want to start investing is to understand your financial goals. Before venturing into any investment whatsoever, it is vital to clarify your financial goal. Clarity is very important. What are you looking at? Are you looking at short-term or long-term goals, or perhaps a mixture of both? Understanding this particular objective would guide your investment decision. Understanding what you want, understanding what you're aiming at, understanding what you're looking for would guide your investment decision. This is very, very important. You should understand your financial goals. Understanding your financial goals is very, very important, and this will make you risk tolerant. Now meet me. I'm Okuri Jeanette Nana, and I've been in finance for about 2 years. Yeah, about 2 years. I recently graduated, and my goal for next year is to help money savvy individuals manage their money and start investing. So you might as well want to call me or refer to me as your investment coach. Now, my name is Okori Jeanette Nana on all social media platforms. On Facebook, you can on Facebook Okori Jeanette Nana, TikTok Okori Jeanette 13. My WhatsApp link will be on the description link, and on Instagram, so Bytes Connect, of course, you can, but then we don't discuss finance around there. We just focus on finance here on this my YouTube channel. On my YouTube channel. All right, let's start with the foundation of any successful investment journey. This is the background of any successful investment journey. And what is that? You should understand your financial goals. Before you even think about investing, you should take some time. You should have a reflection time on what exactly you want to achieve. Are you saving for a down payment on a house? Are you planning for your child's education? Are you aiming for a comfortable retirement? What exactly are you looking at? What exactly are you saving for? What exactly are you investing for? Are you aiming towards a comfortable retirement? These goals, when the financial goals you have already, will shape your entire investment strategy. Understand your financial goals, or will I say, understand your pocket. I think that is that is much more relatable. You should understand your financial goal, what you're looking at. What exactly do you intend to achieve? What exactly is your goal? What exactly are you hoping to achieve from whatever investment you're making? It is very crucial. I am going to be making real time emphasis on this because it is very important. At the end of the day, a lot of persons will ignore and cry. At the end of the day, a lot of persons will still listen to this and be educated. Of course, the sole aim of this video is to keep you informed and keep you educated. So thank you for sticking with me. Now, are you looking at short-term or long-term goals? Consider the time frame of your goals. Another thing to consider is the time frame. Some persons are looking at short-term goals. They want to achieve something like within a short time period or within a short period. Now, short-term goals is like examples of that. We have like saving for a vacation, and this may what involve less risk and much more liquidity. If you're looking long term might be building a retirement nest egg, of course. and this may call for a more aggressive approach. Long term, long term equals higher potential returns. So on your timeline, being clear on what you want to achieve. For any goal, we have what we call SMART. We have a time. The time you're looking at, it really, really, it's really, really what important. Another thing you might want to consider, another factor you might want to look at is your risk tolerance assessment. This is actually very, very important. Risk tolerance. Risk tolerance. Every investment, whatever investment, they come with a certain level of risk. And understanding how much risk you're comfortable with is very, very crucial. You might want to ask yourself some very, very important questions. How would you react if your portfolio temporarily lost value? Now, if you're losing sleep over some market fluctuations, you might want to adjust your risk exposure. On the other hand, if you can weather short-term ups and downs, you might consider much more aggressive investment. Now, to determine your risk tolerance, you might want to um, consider your tolerance level. How would you react? How would you react if this particular investment? Now we have different kind of investments. We have the cryptocurrency, we have the stock bonds, we have the ETFs, we have the real estate, we have different kind of investments, of course. But then what would happen? How would you be able to weather whatever comes with it? How is your risk tolerance level? Not everybody can withstand some of these things, so you might want to consider these things. Take down your pen, start working on them, right? We should also align investments with our goals. Align investments with our goals. Your investment strategy, whatever strategy you're looking at to achieve that investment, should align with your financial goals and your risk tolerance. Whether it's stocks, like I said earlier, I listed some investment stocks. Whether it's stocks, bonds, real estate, or a mixture of all of these assets, every investment should serve a purpose in your overall financial plan. So you might want to do something for me right now. You might want to do something for me right now. You might want to take your pen and your paper. You might want to grab a notebook and your paper and jot down some of these goals. Writing down your goals on pen and paper is something you might want to start considering, because it is really, really, really helpful. When you're looking at that particular thing you've written down some time ago, or probably you wrote it down some time ago, you're like, okay, look at what I'm looking to achieve. In 2024, you have to be intentional about what you want to do. Intentionality matters. Now, you should be able to understand the investment risk. The type of investment risks we have the market risk, and this relate to the overall market fluctuations. We have different kind of fluctuations, of course. We have specific risk, and this involve uncertainties related to the individual investment. We have currency risk, that is the interest rate risk. We have inflation risk. These are all kind of risk you might want to consider. And by understanding this risk, by getting a clearer picture of this risk, you can tailor down your investment to align with your risk tolerance. If you're able to consider some of this risk, if you're able to if you're able to come to the knowledge of this risk, you can be able to tailor down your investment. You tailor it down to align with your risk tolerance, to align with what you can handle. Let me put it that way. To align with what you can handle. What can you handle? So it is less for you to do your research and know all of those things I just listed, market risks and the rest of that. And you should remember something. There is no one size fits all approach to risk. It is a personal factor. It varies from person to person. And by understanding your personal and acknowledging your own personal risk tolerance, you lay the groundwork for constructing an investment portfolio that not only aligns with your financial goals, but also allows you to sleep soundly at night. This is very, very, very important. Maybe when you go to investment, you'll be saying, you don't go comfy sleep. Remember, it is not okay to break it is not okay because this person is doing this one, let me do this thing. No, because this person can weather this kind of risk, because my friend can weather this kind of risk, I think I can weather that kind of risk. No, it varies from person to person, so you have to do your due diligence by what knowing what you can handle. Okay, another factor we might want to consider in investment is diversification. I know we've all heard of the saying don't put all your eggs in a basket, and this holds true in investing. Diversification is key. You have to be able to spread your investments across different assets to reduce risk. If you're not the kind of person, if you're somebody who focuses on one egg, right? Who puts all its eggs in one basket, you might you might want to reconsider. You understand? You might want to reconsider. If you can, okay, let's break it down. You can put 1,000 naira. You can put that on shares. You can put about 1 million on real estate. You can put about 500,000 on cryptocurrency. That is diversification. You're spreading your investment. You're spreading it across different assets. Okay, what exactly is diversification? Diversification is the act of not relying on a single investment. And it also goes on to mean that mixing different kind of assets such as stocks, bonds, real estate, and possibly others. When you do this, you minimize the impact of poor performance in any single investment on your overall portfolio. This way, like I said before, if one sector is facing a downturn, another might be performing well, helping you balance out your returns. Now, it is very, very much important to diversify, because when one of the sectors is facing a hard time, because of course it is not always rosy, you can be able to balance your returns. Another importance of diversification is reducing unsystematic risk. And what is this risk? It is risks specific to a particular investment. For instance, if you heavily invest in one industry and that industry faces challenge, your entire portfolio could suffer. Some persons put all of their hard hand money into a particular investment, into like real estate, and then when that particular investment starts facing bad time or downturn, your pocket might suffer. Recently, somebody hung himself or committed suicide because he actually borrowed money to bet. Probably that was like an investment to him. All right, so it helps you mitigate the risks. You should be able to spread out your investment, like I said before. Now, diversification helps you balance your risk and reward. It doesn't really eliminate the risk entirely, but it helps you strike a balance between risk and a potential reward. And it's not about what you invest in. It is but how those investments interact with each other in your portfolio. So achieving the right balance can lead to a more stable and resilient investment strategy. So as you've heard, diversification does not eliminate risk entirely. What it does for you is to strike a balance between your risk and your potential reward. And another factor to look at here is not just this how you invest, but how this investment would interact in your portfolio. Now, as you explore the world of investment, remember that diversification is a powerful tool at your disposal. It is always at your disposal. So whether you're a conservative or you're a much more risk tolerant investor, building a diversified portfolio can contribute to a smoother ride on your financial journey. Whether you're already a baba in investing or whether you're looking to invest, you understand. Like I've said before, you can start small. All right, you can start small. So let's move to our next point. This is a very crucial part of this topic. This is this is so crucial. Introduction to research and investment. This is very fundamental. A lot of persons are falling prey to scams and the rest of that because they were not able to do their due diligence. They were not able to research. They were not able to make use of their Google, their whatever it is at their disposal. Conducting thorough research, emphasis on thorough research, is key to making informed decision and building a robust portfolio. We'll be exploring that. We'll be exploring how you can navigate the world of investment research. Now, to navigate the world, you might be needing some tools. There are various tools and resources available to assist you in your research. Financial news websites, investment platforms, and annual reports from companies. They all provide valuable information. We have analyst reports, economic indicators, and historical performance data can offer deeper insight. We'll also be looking at how to leverage on these resources effectively in your research process. These tools are here for you. These tools are here for you. They're not just here for nothing. You have to make your research. In fact, do not go into any investment you've not made a research on. Do not go into any investment you don't have a background knowledge on. Please, for your sake. Now, you might want to analyze their financial statements and report. Now, you're looking to invest in a company. You might want to understand what their financial statement is. Some key metrics you should consider are revenue, earnings, and most importantly, their debt level. How much are they owing? Analyzing this can help review the financial health of a company and help you make much more investment decision. You might also want to utilize trusted sources. There are trusted sources. We have people like your investment coach, of course. We have financial expert, reputable publications, and official company filings. But ensure that the information you use for your research is reliable and up to date. This adds a layer of confidence to your decision making process. Now, another factor you might want to consider in your investment journey is cost and fees. This is something a lot of persons ignore. When you see an investment, you see, oh wow, you've done your research, you're like, oh, this is gonna do well. And then you know some of the cost and fees that might come with. Hidden cost can eat into your returns. And we're breaking down some of those common fees associated with sports investment in this, so you have to stay tuned. You have to be aware of them, right? We we need to. It is crucial for us to shine a light on this factor. Understanding the fees associated with your investment is essential. Just the way you see your bank randomly debits you and you're like, why are they debiting me now 247? They're debiting you for probably their government charge, whatever charge. The same thing applies to investment. You need to understand the cost fees. It is important. Now, you should also identify some common investment costs. There are various costs associated with investing, and being aware of them is key. Transaction fees, you can also call them trading fees, are charges incurred when buying or selling investment. Management fees are expenses associated with professional management of investment funds. The reason why I'm making this video is for you to understand some of these terms. So these terms are here for you. We have different kind of investment fees. We have the transaction fees, like I said, and we have the management fees. We're going to explore that to ensure you know what's caught off guard. We also have impact of fees on return. It is important that you grasp the impact of fees on on your overall returns. Small fees can accumulate over time. Yes, small fees can accumulate over time. I call these people, they'll just come and bust your shop because of some of the. Please learn how to calculate, learn how to um, identify those costs, these fees. You can also learn to choose cost-effective options. Not all investments come with hefty fees. You understand? You should be able to choose effective investment what options, the one that will not collect your money too much, like all these fees. Now, as you are navigating the investment landscape, as you are doing this, understanding the fee structure is a crucial aspect of being a savvy investor. By being conscious of this cost, you will not only preserve your return, but also ensure that your investment strategy aligns with your financial objective. All right. Now, market condition is another factor that you should consider in your investment journey. Market conditions, they play a significant role in your investment journey. We'll be exploring on that. Um, It is a factor that significantly influences your investment journey. And understanding the dynamics of the market is crucial for making informed um, decision and navigating the complexities of the uh, financial landscape. Factors affecting market conditions, we have economic indicators such as GDP, growth, inflation rates, and employment figures. They all provide insight into the overall health of the economy. The GDP, the growth, inflation rates, employment figures, they provide insight into the overall health of the economy. And we'll be exploring how these indicators impact market sentiment and investment trends. You have to stay informed. To make sound investment decision, staying informed about market trends is key. And like I said before, when I was talking about um, research, we have reliable sources for market news and analysis. I think there's one I use, investment.com. Yeah, they keep you informed on what is happening in your shares and whatever. You should also learn to adapt to changing conditions. Markets is they're dynamic and the conditions can change very rapidly. You should be able to adjust whether it is a bull market or a bear market marked by declining values. Understanding how to navigate different market environments is essential for long-term success. For long-term success, as you embark on your investment journey, remember that market conditions play a significant role in shaping your experience, and by staying informed and adaptable, you position yourself to make well informed decisions in various market scenarios. So thank you for staying with me to the end of this video. um Thank you for staying with me to the end of the video. And and there you have it. Future investors, these are the key factors to consider before embarking on your investment journey. If you found this video helpful, give it a thumbs up, share with your fellow investors, and subscribe for more insightful content. Remember, knowledge is your strongest asset in the world of investing. Stay informed and stay savvy. Until then, bye.